Good morning. You're watching a live market outlook for Thursday, 2nd of February 2012, prepared by Windsor Brokers. Highlights of previous 24 hours are as follows. The euro, stocks, gold are firmer during the European and US session as well as Asian session on easing of global growth concerns after yesterday's quite positive PMI data encouraged further risk-taking. Asian shares rose overnight as encouraging manufacturing data eased the fears about the global economic fallout from the Eurozone debt crisis. But the euro is still holding under some important levels around the 132, 132.30 zone, as Greece is close to finalize the deal with the private bondholders and to avoid the messy default that is hanging over their heads in the past couple of weeks, as the negotiations are still underway. However, the confirmation of from Greek Prime Minister that they are close to reach the deal gave some support to the single currency. Confirmation of this and final confirmation that the deal has been reached would likely end the current congestion of the single currency against the US dollar and would likely open way for a further extension, as until now the strategy and the main policy was buy the rumors, sell the facts, as euro was running higher but reversing quickly, unable to break some significant barriers. The euro hit levels close to 132 overnight, paid some losses after from yesterday and day before. However, it's, as I mentioned, it still stays capped under 132.32 previous high and the Fibonacci level. The U.S. factory activity expanded at its strongest pace in 7 months in January, while the manufacturing sector in Germany and China showed the resilience to adverse effects from ongoing Eurozone debt crisis. The positive manufacturing data gave the markets temporary break from risk aversion, but it's very vulnerable with some doubts over how much the positive mood would be sustained and how long it's going to hold. The markets are currently digesting the supportive PMI numbers, which have confirmed that industrial activity looks considerably better compared to the last quarter of the year 2011. But there's still some uncertainty, especially over the funding stress in Europe. The recovery in risk appetite weighed on the dollar, keeping its index measured against the key currencies near an 8-week low at around the 78.60 zone yesterday. Intervention fears kept the dollar-yen in narrow ranges, with players building long dollar-yen positions slightly so far. Risk in the euro area have not yet disappeared, however, posing a threat to the rally, as a clear resolution on Greek restructuring remains elusive. Greek has yet to finalize a deal on the long-awaited debt swap with its private bondholders, which is vital to securing a bailout from global lenders and avoid default. Optimism that the Eurozone debt crisis might avoid a turn for the worse revived some demand for the region sovereign debt, sending yields down for some highly intended countries recently shunned by investors due to concern about their funding ability. Yields on Portuguese, Spanish and Italian debt fell, and the easing tension pulled down European interbank lending rates, which had already been helped by European Central Bank commitment in December to keep abundant funds in the system. From Japan, the finance minister, economic ministers kept the pressure on the Bank of Japan to consider easing policy further as yen climbs back to the levels that led to Tokyo to intervene heavily in currency markets last year to protect its export-reliant economy. Bank of Japan Deputy Governor Yamaguchi said he saw no need to ease policy right away, but the central bank could face growing calls to offer more monetary stimulus to help exporters through any prolonged slump, even though it has limited options remaining to support the faltering economy. Economic Minister Furukawa also called on the central bank to ensure that real interest rates remain low, as the Federal Reserve commitment to keep its nominal benchmark rate near zero for nearly 3 more years pushes the dollar lower against the yen. The commodities, gold extended gains on yesterday, and it's rose to its highest level in nearly 2 months as Europe earned on positive global manufacturing data, and expectations that Greek debt deal to avoid the messy default was close at hand. Investors are now looking for a release of U.S. weekly jobless claims due today, data to gauge the health of the world's largest economy after a higher January factory activity was reported for China, the United States, and Germany. The gold is currently moving around 1750, and our initial target on the upside is at 1760 zone, and then 1788 and 1800. Crude oil remains under pressure after yesterday's release of crude inventories jumped more than 4 million barrels last week against the expected build of 2.4 million barrels. The data confirmed expectations that abundant supplies and abnormally warm winter have had a negative impact on demand, and keep the pressure on the oil prices. From today's events already released, Australian and Switzerland trade balance. From Australia, the trade balance shows growth of 1.71 billion Aussie dollars compared to forecast of 1.22 billion, and higher than previous month of 1.34 billion Australian dollars. The Switzerland positive trade balance narrowed to 2.7 billion Swiss francs compared to 2.95 billion previous month release, and 2.85 billion forecast for today. This is mainly due to lower decrease in the exports as Swiss franc is keeping its keeping its strong path against dollar and euro, and it's actually approaching the peg price against euro at 120. The strong Swiss franc is also harming the Swiss exports, as the Switzerland's main trading partner is Eurozone, and the current debt crisis keep the pressure on the euro as Swiss franc continues to appreciate, and this is affecting the exports of Switzerland. Still to come, Eurozone PPI at 10 o'clock GMT, minus 0.1% forecast compared to 0.2% previous month release. From US, Challenger job cuts due at 12:30 GMT. No forecast, 30.6% was previous month release. The key event of today is weekly jobless claims from US at 13:30 GMT. Drop to 373,000 is forecasted for today, slightly lower than previous week's release at 377,000. US preliminary non-farm productivity quarterly release forecasted at 1% compared to 2.3% of the previous month release. Some speakers are also due today. The MPC, Bank of England MPC member Paulson is due at 1400 GMT, and Fed Chairman Bernanke is testifying at 1500 GMT. And that was all for today's economic indicators. We're going to take a look now on the markets and see the latest movements. As we can see, the euro continues moving sideways, capped by 132 zone, also 38.2 Fibonacci retracement of the broader down move from 142.46 to 126.22, and this is for now capping the near-term price action. The pair is entrenched currently within the range of 130.25 and 132, as the bear trend line drawn of 132.32 connecting the next low at 132.12. And yesterday's brief break, false break above here, keeps the upside limited for now. Further easing seen in the early hours of European trading, currently testing initial support of 131.40, where is also 20 days moving average. The next significant support comes at 131 as round figure support, while only loss of 130.25 and 130.00 Fibonacci 38.2 level of the short-term rally from 126.22 to 132.32 would risk a temporary top at 132.32 and allow for a further easing. While holding above above these levels, the positive structure still sees scope for a further extension higher, and the break above 132.32 is to open the next level at around 133 zone, which is 90 days moving average on the daily chart, and the next Fibonacci level comes at 134.29. is 50% retracement of the down move from end of October to end of December, mid-December 2012. Cable is in near-term consolidative mode after yesterday's strong rally surge through a critical barrier at 157.70, November-December range ceiling, also 61.8 Fibonacci retracement of 161.64 to 152.33 down move, surging through these levels and extending so far to 158.81, just close to our next target at 158.87, 18th of November high, and 159.00, above which is to test 159.50, 200 days moving average on the daily chart. The studies on the short term remain still in the positive field, but overbought conditions that are already pointing lower, and on the 4-hour chart breaking below the control line, looking for a corrective action that might precede the fresh rally, as the structure on the short term remains still intact. 20 days moving average currently at 157.60 maintains the past 2 weeks ascent, as initial support stands on the previous stronger resistance at 158.00 and 157.70, ahead of next levels at 157, which is the basically the key near-term support, and only loss of this level would delay immediate bulls in favor of stronger correction. Also close to it is 157.18, currently the main bull trend line drawn of 156.22 low. Loss of 157, as I said, might delay. However, a reversal above this level is ideally seen for a resumption of the past 2.5, almost 3 weeks rally from the middle of January, when the pair rallied from 152.33 currently to 158.81, the high of yesterday. Dollar yen is near-term price action, shows electrocardiography for the pair patient who is close to death, as the pair moves within the very narrow range and just holding above strong support at 76.00 that was briefly tested yesterday. The pressure on the downside remains as a negative structure keeps the further extension lower favored. Loss of 76.00 to open a record low at 75.56 and possibly to extend the weakness further unless Bank of Japan intervenes, as this was mentioned in our earlier presentation, that possible intervention is still on the table, and the Bank of Japan officials would decide when is the best time to enter. However, the first signal came on loss of very strong support at 76.50, and now we are touching 76. Daily studies are firmly bearish, as well as near-term and short-term studies 4 and 1 hour chart keeping the downside favored. Any corrective action should be contained at levels at 76.40.50 and 76.65.75. While only break above 77, our previous strong support and resistance during the past couple of months would provide temporary relief. The dollar Swiss also keeps the near-term price action entrenched with a range of 91.13 and 92.50 as the recovery attempt from 91.13 low of 27th of January failed after breaking important levels at 92.08 and 92.27. Failed to sustain gains, stalling at 92.50 zone just ahead of 61.8 Fibonacci retracement of the latest down leg from 93.38. This keeps current price action within the range. However, the larger time frames still maintain the rather negative tone, while the daily studies are still quite negative, as 90 days moving average currently above the price keeps the pressure on the downside, and the widening Bollinger's favor further extension lower, further correction of the broader uptrend from 70.67 to 95 and 96. Immediate levels at 91.00 and Fibonacci at 90.75, 50% retracement of 85.66 to 91.96. Ahead of figure support at 90.00 and 89.55, 61.8% retracement. On the downside, the 87.38 is 200 days moving average, a bit far at this point from the market. Near-term immediate barrier is the range ceiling currently at 92.50, and only break here to signal possible bottoming, while break above 93.38 and is required to confirm a near-term double bottom and allow for stronger recovery, where 94.00 would come in focus. However, the short-term structure is still negative, and the likely further extension of the broader downtrend from 95.73 is going to be scenario for a short-term price action for dollar Swiss. Quick look at commodities. Gold remains well supported as further weakness of the dollar pushed the yellow metal price higher. 1751 high was nearly 1752 was seen so far. This was today's high, ahead of our initial targets at 1756.63, above which is 61.8 Fibonacci retracement at 1766. And then we have 1790, 1800 previous highs, and also round figure resistance, break of which to confirm a double bottom on the wider picture at 1532, 1522, and open way for a further extension and possible test of 1900 barrier. Some analysts still see the gold much higher, with $2,000 price quite likely in the short to medium term, as the political situation, especially regarding Iran, is prompting investors back into safe haven instruments, and gold is back to this group again after investors for a quite long period of time during the last year were avoiding gold in favor of some other currencies such as Swiss franc as the more attractive safe haven instrument. However, at this point the gold remains well supported, and a brief look on the 4-hour chart, where we can see the trend is still unobstructed as 20 days moving average is following the uptrend. It's coming close to the overbought zone. This might see some corrective action, but 1716, 1700 zone is expected to contain for now. Crude oil broke its recent near-term range floor at 97.43, with 97.10 seen so far remaining under pressure as extending the downtrend, broader downtrend from 103.72 high of 5th of January 2012. Further extension lower. This is actually the latest dip came close to 23.6 retracement of the broader uptrend from 74.94 to 103.72, and the short-term downtrend is now defined by the trend line that keeps the upside capped. A loss of further extension lower actually to face next supports at around 95. This was previous strong support that held the dips in January after when the price found support at 95 zone and bounced higher towards 102, 102.40. However, brief break here, and further extension at 92.70 is our next target, which also marks an 38.2% retracement. Short-term outlook, short-term outlook maintains a negative tone, and further easing is favored for now. Initial dynamic barrier 98.66, currently 20 days moving average, and the static one at 99.46. I would say only break above $100 per barrel would provide temporary relief and avert immediate downside risk. However, regain of 101 level is required, and break above the recent range at 101.20 is required to signal bottoming and open way for possible stronger recovery.